Hello, Assalamualaikum. My name is AZRIN KADIR. My entry number 270662. Now I will present about MGS, Malaysia Government Securities. Alright. The capital market in Malaysia has developed significantly in terms of market size, range of instruments, and efficiency. So this progress has enhanced its role in supporting economic growth and transformation. So in particular, these developments were geared towards nurturing the capital market to fill the institution gap in the financial system and complements the role of traditional lenders. Malaysian government securities (MGS), right, interest-bearing bonds issued by Government of Malaysia through Bank Negara Malaysia Central Bank to raise long-term funds from the domestic capital market to finance the government's development expenditure. So MGS are issued by lender via appointed principal dealers. Government securities. So government securities are usually issued for two different reasons. The primary reason that most government securities are issued to raise funds for government expenditures. So the federal government issues Treasury securities to cover deficit in the annual budget. So additionally, cities will often issue bonds for construction of schools, stadiums, library, and other public infrastructure programs. So a central bank of a country such as like Bank Negara Malaysia will sell debt securities for another reason, that is to control the supply of money in an economy. So if the Bank Negara Malaysia wants to slow the growth rate of money in the economy, so it will sell government securities such as like MGS, Malaysian Government Securities. So this means that it is sucking up ringgit Malaysia from the economy and replacing them with government securities, which results in a slowing of the rate of growth in the money supply. So slowing the rate of money's growth in an economy, of course, will help keep inflation under control. So you need to know that the central bank, of course, Bank Negara Malaysia, in its role and as a banker and advisor to the government, advises on the details of government securities issuance and facilitates such issuance through various market infrastructure that it owns and operates.
Good evening to Sir and my fellow friends. My name is NURUL Anisha binti Muhammad ZAIDI. My metric number is 273178. So today I'm going to present for the part of Treasury bills, or it also can be called as T-bills. T-bills is a short-term financial instrument that is issued by the US Treasury with the maturity period around 1 year or less than 1 year. Treasury bills have been considered as the safe and secure investment since they are backed by the full faith and credit of the United States government. T-bills are normally held until the maturity date. However, some holders may wish to cash out before the maturity and realize the short-term interest gained by reselling the investment in the secondary market. The longer the maturity date, the higher the interest rate the T-bills will be paid to their investor. Next, what is influence the T-bill price? The first one is the maturity dates. T-bills with the longer maturity dates tend to have a high returns than those with the shorter maturities. This is because there is a more risk price into the instrument, which means that there are greater chance that the interest rate could be rise. Rising market interest rate will make the risk less attractive. The second one is the market risk. T-bills price tend to drop when the other investment appear to be less risky. Conversely, during the recession, investors tend to invest in the T-bills as a safe place for their money. Next is the Federal Reserve. Investor will sell when the Federal is at hiking rates because the T-bills will getting less attractive. Conversely, if Federal is cutting the interest rate, money will flowing in the existing T-bills, driving up the price. The last one is the inflation. Even if the T-bills is the safe and the most liquid investment in the security, but because of a few investors tend to buy them in when the inflation rate is higher than the T-bills return. As a result, T-bill tend to fall during inflationary period as investors sells them an optional for higher yielding investment. So for the last one is the advantages and disadvantages. There are 4 advantage of T-bills. The first one is it is zero default risk since T-bills have a US government warrant. The second one, T-bills offer a low minimum investment requirement of $100. The third one, interest income is exempt from the state and local income tax but subject to the federal income tax. And the last one, the investor can buy and sell T-bills with ease in the secondary bond market. Next, the disadvantages. T-bills offer a low return compared with the other investment. Second one, the T-bills pay no coupon interest payment that will leading up to its maturity. The third one, T-bills can inhibit cash flow for investors who require a steady income. And the last one, T-bills have interest rate risk, so their rate could be less attractive in a rising rate environment.
Assalamualaikum and good evening to my doctor. So today I would like to talk about Treasury bond or T-bond. So what is a Treasury bond? Treasury bond or T-bonds are government debt securities issued by the US federal government that have maturities greater than 20 years. T-bonds earns periodic interest until maturity, at which point the owner is also paid a par amount equal to the principal. So the Treasury bonds are part of the larger category of US sovereign debt known collectively as treasuries, which are typically regarded as virtual risk-free since they are backed by the US government's ability to tax its citizens. So Treasury bonds are one of 4 types of debt issued by the US Department of the Treasury to finance the US government's spending activities. The 4 types of debt are Treasury bills, Treasury notes, Treasury bonds, and Treasury inflation protect securities (TIPS). These securities vary by maturity and coupons payment. All of them are considered benchmarks to their comparable fixed income categories because they are virtually risk-free. T-bonds are backed by the US government, and the US government can raise taxes and increase revenue to ensure full payments. These investments are also considered benchmark in their respective fixed income categories because they offer a base risk-free rate of investment with categories lowest return. T-bonds have long durations issued with maturities of between 20 and 30 years. For the next slide is, are bonds a good investment for retirement? Investor must consider several factors including the type of bond, how much interest the bonds pays, and how long their investment will be tied up. Investor must also weigh their risk tolerance with bond risk of default, meaning the investment isn't repaid by the bond issuer. The good news is that Treasury bonds or T-bonds are guaranteed by the US government. They can be good investments for those who are in or close to retirement, as well as younger investors who seek a stable return. Bonds are debt securities that are issued by corporations and government to raise funds. Investors purchase bonds by putting an upfront amount as an initial investment that called the principal. When the bond expires or matures, they call the maturity dates. The investor are paid back their principal. In return, the investor usually receive a fixed periodic interest payment from the entity that issued the bond. Bonds, including T-bonds, can be a good investment for those who are seeking a steady rate of interest payment. Although bonds and treasury bonds are popular, they have some disadvantages and risks associated with them and may not be ideal for every investor. For the next slide, I will show you the type of T-bonds. That's all from me. Thank you.
So good day everyone, my name is Saranya, daughter of INBAKUMAR. My matric number is 275469. So today our group is going to present to all of you about our Malaysian money market instrument. So the Malaysian money market instrument that I have chosen is commercial paper. So basically, commercial paper is a common form of unsecured short-term debt issued by a large bank or corporation. It is typically issued for the purpose of financing for payroll, account payable, inventories, and to meet other short-term liabilities. Usually the maturity on most commercial paper range from a few weeks to months. Other than that, commercial paper is also considered as a liquid asset that can be converted to cash easily. So for the better understanding, let me give an example of the use of commercial paper. So for the example, a retail firm is looking for a short-term funding to finance a new inventory for their company. So in this case, they can use this commercial paper. As how I mentioned earlier, commercial paper is a liquid asset that can be converted to cash easily for the purpose of purchasing the new inventory for the company. Okay, next, there are 4 types of commercial paper. The first one is promissory note. It is a written pledge to pay money. The second one is draft. It is a third-party paper confirming the payment. Third one is check that is drawn on a bank. And finally, the last one is certificate of deposit, or also known as CD. Okay, certificate of deposit, it is an acceptance by the banks of acquisition of a specific amount of money from depositor for a specific time given. Okay, next let me share with you all the features of commercial paper, such as it is a short-term money market tool. It acts as an evidence certificate of unsecured debt, and it can be subscribed at a discount rate, and it can be issued in interest-bearing application. So in conclusion, I can say that the importance of these commercial papers is it is issued by bank and other financial companies to keep a balance on their short-term receivable and obligation. So that's all from me. Thank you.
Good day everyone. Let me start by introduce myself. I'm DARWENA ALAGESAMY, matric number 275589. I would like to present about Malaysian money market instruments bankers acceptance. It is a short-term investment that created by a company or firm and accepted by bank as it will secure by the bank to make payment. Generally, it mature within 30 to 365 days upon issuing date. The minimum amount is RM50,000 and in multiple of RM1,000. Bankers acceptance active in secondary market. It is not an SSTS instrument. Bankers acceptance is a short-term financing instrument that finance sales and purchases. Bankers acceptance traded in discount value. Let's take a look on the example of banker's acceptance. Purpose to create banker's acceptance. Banker's acceptance can be created as financing tool or investment tool. On the financing tool, banker's acceptance created to as a relatively safe form of payment for both sides of transactions. It representing a promised future payment by bank. It accepted and guaranteed by bank to pay at the specified date of banker's acceptance. It created to as payment instrument for exporter to finance the payment before shipment of goods. On the other hand, for investment tool, banker's acceptance sold or traded immediately by holder the maturity date. Sell or trade to the secondary market at discount rate on face value. BA holder get the investment gain on short-term funds. Let's move to the benefits of banker's acceptance. First, low financial risk. Sellers will be more interested in dealing with buyers who are backed by known and reputed bank. A buyer with banker's acceptance usually less risky. The interest rates on banker's acceptance are low compared to the benefits that the buyer can garner from it. Next, no advance payment. Since the buyer has a good relationship with the bank, he or she does not have to worry about making advance payments. Banker's acceptance helps to build trust between the parties. Lastly, promote business growth. A new buyer with banker's acceptance will always attract more sellers in comparison to the buyer who does not have any guarantees from the bank. There were 4 risks involved in banker's acceptance. First, translation risk. It normally associated with foreign currencies and foreign assets. Reputation risk, when they default on repayment. Third, transaction risk. It involved in the period of long time in between entering into contract and settling the contract. It might have exchange rate risk associated. Lastly, credit risk. The banker's acceptance relying on the creditworthiness of the borrowers. Banker's acceptance drawn on a discount rate value. How banker's acceptance traded? Banker's acceptance will be drawn by a bank customer when they need banker's acceptance to finance their purchasing or selling of goods and accepted by the financial institution. The holder of banker's acceptance will keep it until maturity date or trade to third party when the holder needs the short-term funds or immediately cash. Investor or banks can buy the banker's acceptance from an accepting bank with discounted value. Then during the maturity date, the investor will get the full stated on the banker's acceptance.